Hey Shafiq, I'm making this video specifically for you because you said in the masterclass you've been having a little bit of misunderstanding when it comes to enterprise value. You want to understand it on a deeper level. So what I got here is we're going to look at Microsoft. And I've got a brand new spreadsheet right here. So first, what is enterprise value? Enterprise value is one version of a valuation of an entire company. When I say an entire company, this incorporates debt, cash, and the overall market value of the company. A couple other things as well, but we'll get to those shortly. In general, the main overarching point of enterprise value is we want to think as a total business owner, as if we were to own the entire company. So what we're trying to do here is we're trying to find the total value of the company as if we were either owning the entire company or we were going to purchase the entire company. That is all that we're doing here. We're just trying to find what is a decent estimate of current market value of the company when considering its cash and debt. So let me bring up the tabs here. We need for this financial data. We need, where's share price or market cap? Market cap right here. And we need the balance sheet. That's it. Market cap and market cap on the front page and balance sheet. That's it. And when you're looking at the balance sheet, you always, I think we talked about this the other day, you always only use these numbers right here because these are the most recent data. On the income statement and the cash flow statement, you add these numbers up to make the trailing 12 months numbers. So for example, these 4 quarters right here, we would add up. But in the balance sheet, you always just add these numbers here because these are the total numbers. Okay, so we are millions quarterly. Okay, so I'm going to show you step by step what this is. So EV equals market cap or market value of common stock, which is market cap. Market cap plus, oops. Okay, so I'm not going to be able to do that. Plus market value of preferred shares, which most companies I look at, most of the companies I look at are smaller companies, so they don't have preferred stock or minority interest. This Microsoft does not look to have any preferred stock. So plus oops, forgot to put in the number. Market cap was, what is it? And market cap is just at whatever point in time you see it just change there. It's whatever point in time you look at the company. So 765.976 billion. 765.976. Actually, let me go up here. in millions. So just so I know what these numbers are. So millions, billions. So go back here, market value of debt. This is in the EV calculation, this is just short and long-term debt. Typically, I add operating leases and those kind of thing, but for this exercise, just focus on short-term and long-term debt for the time being. And all these adds. Okay, so short-term debt 3677 billion, long-term debt. So what is that? Calculating it on my phone right now. 3677 plus 73480. So that's 77,157. Plus minority interest. And it has 0, looks like, because it usually says minority interest over here. If there is, zero, cash, and cash equivalent. Let's yes, okay. And I'll put this in red just to illustrate the point. Which that's not the one I wanted to do, but that'll work. That we subtract this number, 9,221 billion. So you see this short-term investments here. We'd have to go into their financials to see what these are. I assume there's some kind of bond investment, but until we go into their financial statements, we don't include this number because we don't know for sure. This will come in when the TEV, when we do the TEV calculation. We'll know for sure when we do the TEV calculation. Or this will be included in the TEV calculation. So, but since we're just doing the EV, just this number right here, 9221. Too many tabs open. 921. Okay, so market cap plus preferred stock plus short and long-term debt plus minority interest minus cash and cash equivalents. Again, typically I know this says right here to include investments. Typically I do not in the EV calculation, again, because I use the TEV calculation as well. Frankly, it doesn't matter what you do here, as long as you keep it consistent going forward. But yeah, in this, just for this exercise, and I'll do a TEV calculation after this as well, just to kind of show you the difference and illustrate the difference, at least in terms of the investments, what that would be. So we've got all the numbers. So EV equals 65976 plus 0 plus 77157 minus 9221 equals 833,912,000,000. So what this means here, because this number is higher than this number, it means that Microsoft, this is one side Microsoft could be overvalued as of right now. This is just why I emphasize the term one sign, because again, this is just one sign we use in all of our calculations and analysis. We come from multiple different point of views, and we come with multiple different kind of thought processes, and we kind of combine everything together to get one full picture. Sorry, I've got a little bit of OCD when it comes to that kind of stuff. So that's literally it. That's all you do with the EV calculation. So if you were to include cash, C and CE, and investments in here, this number would go to, there's no long-term investments, so 123,049. 123,049. So let's do the whole calculation over again. These numbers are the same. The only difference is this number between this number. So 765, 976 plus 0 plus 77157 plus 0. Oop, and this is supposed to be red. So minus 123,049, 720, 720,084. So again, this number usually it's not that large of a difference, so you won't see this very often. But when you do, and this is why we do both EV and TEV calculations, because this would show up in the TEV calculation no matter what. So this being such a different number from this, or these two numbers being so much different, means this being lower than the market cap, that this is a sign the company could be undervalued. Again, on this one metric, could be undervalued. So I don't want to get into TV right here because I don't want to confuse you. But again, depending on which numbers you use, it doesn't matter as long as you keep them consistent. If you want to include C and CE in there, and again, I probably would, but since I don't know for sure what they are without digging into financials, I'm not in this case. Most of the time I would, once I figure out what the short-term investments and long-term investments are. But again, this is why we do the TEV calculation, because this would show up automatically in the TEV calculation anyways. That considers short-term and long-term investments. So EV, simply market cap, which is share price, times the current number of shares available, preferred stock, which most companies don't have anymore, short-term and long-term debt, straightforward there, just the debt they have on the company. Minority interest, again, most companies don't have this. Minority interest is interest in other companies, subsidiaries, third parties, joint ventures, things like that typically. A lot of companies don't have that either. And cash equivalents is typically cash they have on hand or at the bank that they can get access to within 3 months. When you throw in, and that's another reason I didn't include this here because I don't know what it is. Short-term investments are typically 6 to 12 months, or at least in terms of accounting rules and law, 6 to 12 month investments. So again, they don't necessarily have full access to this. They might be short-term bonds, stuff like that. We don't know until we dig into financials, which is why I stripped it out here. But all we're trying to do here is get to this number, which, again, we're just trying to figure out an entire value of the company as if we were a total business owner. So let's go through this again. Let me see here. What company? Actually, let's just go here. This is a company I'm looking at in Australia right now. I haven't even done preliminary analysis research on it yet, so I don't even know what this EV is. But this is a company I'm getting ready to do case studies on Australian companies, and this is the one company that on a very preliminary basis, again, I haven't even done my preliminary analysis sheet at all, but on a preliminary basis, just based off the numbers, this one looks interesting. So let's do the EV for this one. What is the ticker? CWLDY. I'm sorry, I don't know. The new Morning Star just slows my computer down to a crawl. So I'm gonna get rid of this. And this is a perfect example. I think I've showed you, or it's in the resources for this week's content talking about EV and why I don't rely just on market cap. This is a perfect example because every company has cash and almost every company in the world has debt, and market cap doesn't bring those two into factor whatsoever. Which, as a total business owner, obviously you want to know how much cash and how much debt the company has. So, okay, so this company is 7.00033 billion. Oops. 703. Get rid of that. Get rid of that. And I actually calculate this a little bit backwards than what it shows on Investopedia. I take out cash first and whatever. But let's just keep going this way for simplicity's sake. So, oops. Preferred stock. See, here's minority interest. They don't have any preferred stock. So 0, 0, plus short and long-term debt, 338. This company has a lot of debt for its size. 8 plus 1464, 1802. Minority interest was negligible, but again, we'll add it in here for calculation's sake. 34. Okay. So this is what you'll see most of the time. Most companies just have cash equivalents. They don't have short-term investments there. This is 1771. Okay. So 7003 plus 0 plus 1802 plus 34 minus 1771 equals 7068. So what that means is that, again, this is about fairly valued, at least on an EV basis. It's one side the company might be about fairly valued now because it's very close to the current market cap. So that's it. I mean, that's EV in a nutshell. That, I mean, there's more nuances to it, not necessarily to EV, but when to TV and other stuff you get to in the course. But EV is very straightforward. We keep one thing in mind. All we're trying to do is figure out a total value of a company as if we were a total business owner looking to either own, or we already own the company, or we're looking to acquire the company. So we're trying to figure out a baseline price of what the company is worth today. Not what it should be worth or what it is worth, but what it's worth on the stock market today. Not what its true intrinsic value is, which we'll get to that in the valuation section. I think that's week 5 and 6 in the course. This is a baseline for what the company is worth on the stock market today based off its market cap, preferred stock, short-term and long-term debt, minority interest, and cash equivalents. So I always get this question every time I talk about EV. Why do we subtract cash and cash equivalents? Because if we were to take over the company, or we already own the company, we would already have this cash. If we were to take over the company, this would come with the company already. So this would likely either not be considered in the purchase price. It would automatically come with the company along with its debt and all this other stuff that we're talking about. So that's why we always subtract cash and cash equivalents, because we would automatically get this cash once we either took it over or if we own the company already. I hope that makes sense. Let me know if you have further questions about this or anything else, and I'm looking forward to our first one-on-one session, Shafeeque. I hope this helped again, and let me know if it did. I'll talk to you soon.